Hey everyone, in this video I'm going to take you through from the very beginning how you can start investing today. And now I know as a beginner how daunting it can be having money sat there on the sidelines. You feel like you're missing out and you need to start somewhere. Well, this guide I'm going to take you through from the very beginning what to invest in, why you need to invest and how you can invest. And it doesn't matter if you're 18 years old or 50, not that 50 is that old anyway, about how you can get started today. So go ahead, get yourself a pen and paper, get comfortable, get yourself a tea or coffee, plenty of biscuits. There's going to be timestamps from the beginning to the end so you can skip through to the bit that interests you. Let's get straight in from the beginning. It's funny, isn't it, that at school we're not actually taught anything about finances. So we go to maths, we learn our times table, long division, but actually nothing to do with mortgages, investing, how interest rates work, how compound interests work, and how the world works. So really, when we're thrown into the world of work and we start earning ourselves some money, we've got no idea really what to do or how to read the balance sheet of a company. Finance and investing is something we typically have to just learn as we go along, which is really annoying and just means that we have to make lots of mistakes, speak to friends and family who are equally as confused as we are, trying to work out what the hell we need to do. So the problem is you end up with lots of people who have no idea at all what they're doing and don't know where to start, versus the people who are more experienced getting further and further ahead, creating a massive gap in society. And I truly believe we can narrow that gap so everyone's got a chance to invest. I'm not a qualified financial advisor. All I'm sharing in this video is all of my experience so far of around 10 years worth of personal investing, all the mistakes I've made along the way, and trying to give you as much information as possible of how to get started and what I'm doing at the moment. Believe me, I've made plenty of mistakes. I've been through everything you're thinking of right now. I've worried about all the money, where it's going. Am I going to lose everything the next day? Am I going to wake up broke? I've been through all of those emotions, all of those pain points, but I'm here today, I've made it, and I'm going to hopefully help you get through the next 10, 20 plus years as well. It's never been easier to get started today. It couldn't be easier. As I've mentioned in some of my previous videos, you can pull out your phone right now, be signed up, buy a share of a company in less than 5 minutes, and before you know it, you're an investor. That's all it takes. But of course, with that amazing opportunity comes risk as well. So it's just making sure that you know all of the information that you do before you start investing today. Firstly, it's really important to remember why we're investing in the first place. The easier way to ask that question is by saying, what happens if we don't invest? And if we don't invest our money and we keep our money in a bank account, in just a savings account of 0.1% or whatever amount of money we're getting at the moment, that money loses its buying power every single year. And that is what's known as inflation. And inflation is why Freddos used to cost about 10 to 15p compared to their price now. It's also why the National Lottery used to charge £1 for lottery tickets and now it costs a whole £2. Ugh. So we need to invest our money to grow it faster than inflation. That means that we can actually get more purchasing power for our money, and then we can retire sooner and live out our financial goals, whatever they may be. And that's completely up to you. Not everyone wants to be a multimillionaire or live like an absolute frugal student for the next 20 years, but it's completely up to you. But the main thing we need to consider is how do we get there faster? If we invest consistently over a long period of time, we should end up with a good amount of money which will have beaten inflation and then allow us to have a lot more choices in life. And that may mean retiring 5 to 10 years earlier. It might mean nicer holidays. It will just ultimately give you the freedom to be able to do what you want when you want. You can go ahead and splurge on nice things in the house, or you could potentially take the grandkids out for a nice day out. Completely up to you. The main thing here is that we need to invest our money, because if we don't, we are literally losing money every single year. That lovely pot of hard-earned money that you've been saving up on the sidelines will lose its purchasing power, and before you know it, you'll end up with nothing.
I've got nothing left. I've got nothing left.
Although this guide is for beginners, it's highly likely that you're already an investor, whether you know it or not, and that's typically through your workplace pension. So every month you'll see the deductions come out of your payslip if you are currently employed in the UK, and that'll be going into a pension pot somewhere controlled by probably one of the big brokers, maybe someone like Scottish Widows or AXA, Aviva, for example, some of those big players. The next time you get one of those pension slips through in the post, have a look through. It should tell you how much you've got in play at the moment, how long it might take for you to be able to retire, and how much you might be expected to earn if you earn that amount of money for the next 10, 20, 30 years. And it will actually tell you what you're invested in as well. But it won't spell it out so clearly. It will be put in little funds and different names. So have a look through it, have a Google, have a quick look. But believe it or not, you're already an investor. Your money is already working for you. But this guide is really about how we can make it work better, and you can take control of that actively. Now, there's loads of ways to invest. In fact, I did one recently on one of my videos about 8 different ways you can invest. And that's taking your money and putting it into a whole number of different things to allow your money to grow. In this video though, I'm specifically going to be focusing on opening a stocks and shares ISA and investing your money into the stock market every single month for the rest of your career and the rest of your adult life. And the reason I'm choosing this is because I believe it's one of the easiest ways to get started, requires the least amount of time, and is the most sensible for almost every person in the country. Firstly, I'm not talking about lots of money here. I'm talking about relatively small amounts of money which we need to find each month. Something like £50 to £100 will depend on the different provider that you put your money into. But if we can start with that amount of money, that's not too little at all. Some platforms will even allow you to invest as little as £25 every single month. And I truly believe this when I say this, that that's not too small amount of money to get started investing, and it's worth doing it just so you understand how the process works. Now, why am I choosing stocks and shares, and why am I specifically choosing a stocks and shares ISA? We're very fortunate in the UK that we're allowed to invest up to £20,000 per year tax-free into a stocks and shares ISA. The reason behind that is because you've already earned your hard-earned money, it's already been taxed, and now as an incentive to invest your money, you're allowed £20,000 worth of investments, and all of that capital gains and all of the income from that £20,000 is tax-free for you. Now, you can only have one of these accounts, so then on the next step, we're going to talk about how we're going to pick a provider to open up our stocks and shares ISA. But just remember that that's one per person per year that you can open up. But to be honest, just pick one and stick with it. Okay, we've got our money ready. We're confident, we want to invest. How do we get started? First things first, we're going to need to choose a provider. Now, this just means someone that's going to allow us to open up a stocks and shares ISA who is regulated by the Financial Conduct Authority in the UK to provide us with this service. So those can be the massive, huge providers like Vanguard, Hargreaves Lansdown, or Fidelity, or also some of the newer kids on the block such as Freetrade, Trading 212, Nutmeg, and Moneybox. All of these platforms will allow you to open up a stocks and shares ISA, and they're also all regulated by the Financial Conduct Authority in the UK, which is really, really important because that means that your money is guaranteed by the government up to £85,000. So if the company goes bust, you will get that money back. Now, I'm not going to go over the specific differences of all these different platforms, how much they charge, etc. There's not a huge amount of difference if we're honest about how they operate. I'll leave that completely up to you. There's loads of different videos about comparing the different providers, but you'll be absolutely safe and absolutely fine with these ones because the majority of people use these platforms to do their investing. So you've chosen your platform of choice. How do I get started? Super simple, couldn't be easier. All you need to do is go on the website or go on their app, depending on which provider you've chosen, and you want to specifically choose to open up a stocks and shares ISA. You'll typically need a short amount and small amount of details, so name, address, national insurance number, etc., and how much you want to invest per month. And you'll typically be asked to choose at that point also what you want to invest in. But don't worry, you can pause at this point, and I'm going to take you through everything you need to know about how you can invest and what you should be investing in, and what I personally invest in at the moment. Firstly, what the hell is the stock market? It's probably one of the most overcomplicated subjects out there, and probably for good reason, because lots of people out there want to make this thing as complicated as they can to put off lots of people like you and me, so we have no idea and we end up paying loads and loads of money to people who claim to know what they're doing. But let's break this down really, really simple. Now, I'm sure you've heard of terms like the FTSE 100, the S&P 500, the Nasdaq, the Nikkei. These are all stock markets. These are all collections of companies who are on the public market that you or me or anyone else can buy a share of. The stock market effectively just brings together buyers of shares with sellers of shares, and that market is generated from there. The stock market is basically like going to do your weekly shop at Tesco. You go down the different aisles, you pick up your different stocks, or in this case, your fruit, your veg, your meals, your meat, your cereals, your drinks. Get yourself down to the self-checkout or the other checkout area, pay for your goods and walk out. And there we go. You've got your stocks. It literally couldn't be easier. The stock market is effectively just a place that enables this exchange of bringing together buyers and sellers. But where do you start? There's so many things to invest in. I can go on Wall Street bets. Everyone's talking about GameStop, AMC. Should I invest in cryptocurrency? Should I invest in the FTSE 100? Should I invest in the UK? Should I invest in the US? What about Europe? What about emerging markets? What about the rest of the world? Okay, don't panic. Look, let's use another analogy here. So if we think of investing like our wardrobes at home, we've got summer clothes, we've got winter clothes, we've got football boots, shoes for going out, trainers, or I'm sure if I looked at a lot of yours in 2020, it would probably just be jogging bottoms and t-shirts. But the main thing is here that we've got a good, diverse collection of items in our wardrobe because we're effectively ready for whatever the UK weather has to throw at us. And if we take this example to a really bad extreme, we wouldn't have a complete wardrobe just tuxedos, would we? That wouldn't look good when we turn up to a job interview.
Mr. Huff, Mr. Jenner is ready for your interview.
Actually, we'll be interviewing as a team.
Looking back at 2020, hopefully you can see where I'm going with this one. Effectively, if we don't have a good wardrobe with different diverse amounts of clothes and different kinds of clothes, we would put ourselves in a pretty bad place. If it starts hammering it down with rain outside and all we've got is nice soft woolly jumpers, we're not going to have a very good day. So just like a balanced wardrobe, what we're looking to do as investors in the safest possible way is to have as much diversification as possible. And all that means is having none of our eggs in a single basket. So for example, we want to make sure that we're covered in the event of bad things happening. Again, 2020. This means that we want to have our money working for us in all of the different sectors. So for example, in the financial services industry, in the retail industry, in the tech sector, industrials, property, you name it. But if we diversify our portfolio, i.e. have lots of different things in our wardrobe, we'll put ourselves in a really good position. Quite simply, if we have all of our money and all of our investments in a single stock, this is a lot more risky than having our investments spread across 100 or 200 or more different stocks and investments. Because for example, if that one company were to go bust, all of our money's gone, whereas it's a lot less likely that 200, 300, 400 companies will all go bust and our money will go down with it. Now, I know you're still asking me here, what do I choose to invest in? There's loads, there's hundreds of companies out there. How do I make a diverse portfolio? Well, luckily, we've got you covered. One of the best tools out there for investors to use, and that's both beginner investors or more experienced investors, is index funds. And you may have already come across these, sometimes known as mutual funds, sometimes people refer to them as exchange traded funds, but effectively these are a collection of companies which you can buy as a single piece of stock. And there's hundreds of funds out there, but don't let that scare you, don't let that complicate things. If we again think about our supermarket analogy, we've got different shopping baskets with different people's needs in. Some people have gone just to get all of their vegetables. Some people have gone for the whole weekly shop. You can choose which basket of shopping you want. For example, there's funds out there which will track the S&P 500. There's funds out there which will have a share in every single FTSE 100 company. There's funds out there which will track all different companies in the same industry, like clean energy, for example, big tech, for example. But from our perspective, we're going to keep things really nice and simple and try and choose a fund which is going to give us a really nice broad starting point. Just as an example, to make funds even clearer, if we put £100 into an S&P 500 fund, for example, that £100 is effectively split between all of the different 500 companies that make up that market. And the weighting of that depends on how big the company is. So for example, in the S&P 500, the American stock market, the £100 will get split up more toward the likes of Apple, Microsoft, Amazon and Google, and less towards some of the smaller companies. And the benefit of doing it that way means that we don't have to buy individual shares in 500 different companies, which would cost us a lot of money. Now you could happily go on, pick your own stocks, pick which individual sectors you want to invest in, pick funds, that's completely up to you. Like I said before, I'm not a financial advisor, but I'm just trying to show you some of the journey that I've been on. And from my personal opinion and my view, having some basis of index funds is a great place to start your portfolio. And another reason I choose index funds, and most people choose index funds or other ETFs or exchange traded funds, is because they've performed really, really well. And there's actually plenty of research out there that shows these kinds of passive investments, and they've beaten a lot of the actively managed funds where people have tried to pick different stock to outperform the market. They failed miserably the vast majority of the time. In this section, we need to work out which funds to buy. We've set ourselves up with the Stocks and Shares ISA, we're on Vanguard, we're on Hargreaves Lansdown, we're on Fidelity, and now we're looking at the huge amount of funds which we need to figure out where we put our money. For specific funds, if you want more detail on those, all of the information is on the respective websites of the different brokers. You can go through in detail in the datasheet to look through what that fund's invested in, how much it's going to cost you in terms of fees every year, who manages the fund, and what makes up that fund. You'll need to do all of your own research on that one, and there's also plenty of great information on YouTube and across the internet that you're able to use. On the screen now, I'll put up some of the most popular ones from Vanguard. So what do you do once you've actually invested your money? Sit back and relax? Here's where we need to take some lessons from some of the world's best investors to help us manage our own expectations. Firstly, as I'll say time and time again on this channel, time in the market beats time in the market. If you invest consistently month after month, year after year, you'll get compound interest working for you, and that's one of the best ways to generate wealth over the long term. So that really leaves you with two main jobs that you need to do now. Number one, keep up that consistency, keep investing month after month. If you can increase your investment because you've got a pay rise at work, or if you're happier putting more money in, you've got a bit spare on the sidelines, go ahead, feel free to do that. And then number two, really, really important one, avoid selling. This is more down to the whole psychology and the mental aspect of investing. I know what it's like having invested my money, and I know what it's like every single day. You'll be checking the website, checking your phone to see how much money you've made, see how much your investments are up, see how much they're down. You've pretty much got to put that money in and forget about it. Don't see that money as something that you're going to live off or something that you're going to sell. You need to see that money as a long-term investment. There are going to be some bad years, there's going to be some big dips, there's going to be some massive weeks of gain, but ultimately over the long term, you're looking for a substantial investment and a good amount of money that you've grown month after month. And the last thing you want to do is start panic selling or getting rid of those investments just when you think the market's going down. There's a reason that experienced investors call retail investors like you and me the dumb money, because we get all excited when things go up and we try and keep putting more money in, and we sell everything when things come crashing down. We want to completely avoid that, completely stop looking at it, stop thinking about that money that's even available to you. Once that investment leaves your bank account, forget about it. Although I still do look at my investments every day just for fun. And point number three, and I'm going to tell you about point number two again, seriously. You just need to be consistent here. Warren Buffett once said the stock market is a device to transfer money from the impatient to the patient. Here's a really good example. Think about this. If you've been invested in the market for a long period of time and you happen to put all of your money in at the peak of the dot-com bubble, and then you thought, oh crap, and then you sold once things went bad. Well, if you just held on to that investment and consistently invested year after year, you'd be up now. So the worst thing you can do is sit on the sidelines and try and work out when is best to invest, because nobody knows the answer to that. The only thing I would say is the best time to invest was yesterday.
Nobody. I don't care if you're Warren Buffett or if you're Jimmy Buffett, nobody knows if the stock is going to go up, down, sideways.
One of the next things we're going to think about now is how long do we invest for? This one's all down to you. Your own goals, how old you are now, how long and how far down the road that you want to be your retirement date, what you're exactly investing for. This one is completely up to you. I'll give you an example from my perspective. I'm 32. My goals would be maybe to retire at something like 50, or at least have some sort of financial independence by my late 40s, meaning that I'll be able to quit full-time work and then do whatever I want. To be able to have from my investments money coming in, or investments that I'm able to sell each year to pay for my living costs, pay for nice holidays, and allow me to live a completely financial free life. But that is completely up to you. That is your decision. The difficult part and the most challenging part of investing is just making sure that you do it. Again, staying consistent. Make sure that you start investing as soon as possible, because that extra few years that you're invested compared to someone else and some of your friends can end up with a huge amount of money. I recently did a video where I compared two different people who started investing, one at 25 years old and one at 32 years old like myself, and just in 7 short years, closer to their retirement, you can change a £1 million investment pot to a £2 million investment pot with that 7 additional years worth of compound interest. It's insane. Right, you've done it. You've put some money together, you've opened up a stocks and shares ISA, you've chosen the funds you want to invest in, you've agreed to invest, you're now an investor, you're going to put money in every single month without fail for the next 20, 30, 40 years of your life, wherever you are. Congratulations, you've made it further than a huge amount of people, and I wish more and more people did what you have just done. So congratulations. Your main job is now to be consistent. Honestly, that's the biggest advice I could give now. Keep investing month after month, all the time that you can do it. And that is where you'll be able to take advantage of compound interest and take advantage of that long-term growth. Now, nothing's certain, nothing's without risks. Things go up and down, but not taking action is what could really cost you dearly. Remember what we spoke about at the beginning. Remember how inflation is going to cost you money every single year, so you need to make your money grow. Thanks for watching to the end. I hope you've enjoyed it. Drop me a like if you've enjoyed the video. Feel free to subscribe for more, and I will see you lovely lot in the next one.